Thank you, everybody. You're too kind. Hello, my name is Mark. I'm the stock market jobber. Thanks for checking out our video here. I'm a former institutional trader who is now on a mission to teach people like yourself. I spent 20 years in the institutional trading world where I traded at two of the best hedge funds or money managers really in history, Mario Gabelli and Steve Cohen. I was also the head of trading at three different institutional money managers where I oversaw various trading strategies, all types of mutual funds, hedge funds, high frequency, deep value. So I was a market maker. So when it comes to trading, I've been around the block a few times, and now I want to teach people. So let's take a look at SPY here. Now, in the institutional trading world, we don't really focus on bizarro methods. We focus on basic market fundamentals. And one of our market fundamentals is that some price levels are more important than others. This is a really, I mean, you can't say it enough. You can look at pretty much any chart and identify these important levels. Now, the SPY looks weak. I think it goes to 390, and there it gets a bounce. I think it eventually breaks and it goes lower, but we're going to get a tradable bounce. And just because it's going lower, don't think that there's not a way you can make money off of it. Check out my video from a few days ago where we talk about the inverse ETFs or ETFs that will go up if the market goes down. So you can profit off a bear market. As a matter of fact, it's easier to make money in a bear market because markets sell off faster than they go higher. That's because, I mean, you can see right here, we go up, and then wham. That's because selling happens because of fear, and fear is a more powerful emotion than hope. Hope is what drives markets higher. Fear is what drives them lower. So don't be afraid of a bear market. I mean, no one really wants them, but you don't need to put your head in the sand or just go to cash. There are ways to profit from them, and a lot of our stock market jobber people here have done so. Now, in terms of an important level, let's just look at this black line here. This is the 390 level for SPY. Now, notice something that's kind of extraordinary. It was a support level, then it became a resistance level, then it became a support level, then it became a resistance level, then it became a support level, then it became a resistance level, then it became a support level. Now, for some reason, this particular price level is important for SPY. I don't know why, but it is. The SPY just seems to like this level. So we have support turning into resistance because of buyer's remorse. There are people who bought here. Now, assuming they didn't sell, when the price goes lower, a lot of these investors regret buying, and a lot of them tell themselves, I made a mistake. I want to get out, but I'm only going to do so if I can get out at break even. So we have remorseful buyers placing their sell orders at the same level they bought at. So that could turn support into resistance. Now we have resistance turning into support. This is because of remorseful sellers. Resistance becomes support. Investors sell, and when the price goes higher, a lot of these investors tell themselves, I shouldn't have sold. I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price that I bought them at. So if the market comes back in, we have remorseful sellers placing buy orders at the level they sold at. If there's enough, the level that was resistance can convert into support. So here we have a little bit of support we found around the $400 level yesterday. And that's not surprising because sometimes we know why a level is important. And people like nice round levels, whether a retail investor or some big shot institutional hedge fund trader. People tend to like to get things done at round levels. People don't say, "Oh, I'll buy it if it gets to 398 or 403." I'll buy it if it gets to 400. So anyway, I think that's going to be our next stop. I mean, it might take us a few days to get there, but my short-term outlook is bearish. And the reason why I think we would get a bounce there is because it's been an important level. I mean, we could see here resistance. This little skinny black line is the 410 level. Resistance here, became support here. Then the support broke, and that's why we're going lower. Now, what is support, right? It's a large group of buyers or investors who are willing to pay around the same price for a stock. When the price goes lower, it's because there's not enough buyers to take in all the sell orders. But when we get to support, the tide turns, and all of a sudden there is. When support breaks, it's not just symbolic. You might have heard the term, the support broke. It tells us that support breaking means the price goes below what was support and stays there. This tells us something. This tells us that the investors who created the support with the buy orders have left the market. They either finish their orders, they cancel their orders, regardless. Anytime you take demand out of a market, it sets the stage for supply or sellers to push the price lower. Basic economics 101. If you can understand supply and demand, I can teach you how to read charts. Now, this is what's driving this. People could talk about this, they could talk about that. It's China, it's Ukraine, yada yada yada. Well, we as traders, we really kind of zone all the fundamental news out and really just kind of focus on what the market's telling us what to do because the market's never wrong. The pundits seem to be always wrong, or the experts seem to be always wrong. Got resistance here, resistance here. We broke the uptrend, and despite this big move lower over the last few days, Apple hasn't really done any kind of a rebound. That's what we call bad action. Usually, when something really gets pummeled, there's a little bit of a bounce. And if there's not, there's a chance that it's going lower because it tells us the buyers are not ready to step into the market. Now, Apple and Microsoft, I'm going to bring up Microsoft. Between these two stocks, they are 8% of the. Um, Actually, no, they're 12%. Yeah, 12%. They're 12% of the S&P 500. The S&P 500 is 500 stocks, hence the name. But these two stocks have such big market caps that they make up 1/8 of the index, or 12% of it. And this is just really negative action here. Just got this big aggressive selling here. Notice how what was resistance became support because of that seller's remorse. And we've found a little bit of support around the 250 level, but again, we've had this big sell off and we still show no signs of a rebound. So my guess is that we still go lower. And this is the technology sector. This is an ETF, XLK, the Spider Technology Sector, that tracks the technology sector. That's the biggest sector of the S&P 500. It's about 27, 28%. And this is why this sell-off over the last few days was kind of easy to call. And if you don't believe me, look back at a couple of the prior SPY videos from the last few days, and you'll notice a bear on the front of the cover. So, as markets go, this one was pretty easy to call. When you get a sector like technology that's setting up at a clear level, resistance, resistance became support. When this support started to give way, it was pretty obvious that SPY was going to go lower. The biggest part of the technology sector, which is about 45% of it, is Apple and Microsoft. So one of the things we teach at Stock Market Jobber is that by looking at the different sectors that make up the market, we can get an idea where SPY is going to go. All right, everybody, I appreciate it. Please make sure you subscribe to Stock Market or our YouTube page here. Please make sure you check out our website, stockmarketjobber.com. And I will talk to you soon. Thank you, everyone.